Hi. Thanks everyone. Thanks for joining. I'll discuss the UTI Focused Fund strategy. So as the name suggests, it is in the focused category of SEBI classification. It's a concentrated strategy where we are allowed to invest in maximum of 30 stocks, and we manage the fund with a blend of growth and value as an investment style. So what makes the product unique is, as I said, it's a concentrated portfolio. So we have a very wide and experienced research team covering almost 400 stocks. So we try to pick the best 30 ideas from our research coverage. And the good part is that the fund does not have any market cap restriction. So we can look for best ideas across sectors and across market capitalization. So what that does is gives a very unique positioning to the fund in terms of very high active share. If you compare to any of the other diversified strategies, this fund, because of the concentrated nature, will have a very high active share, which means that the fund has the ability to give good alpha to the investors. So before going into the details of the fund strategy, let me take you through some of the few observations which we have across market caps and across the ROC tiers of companies. So just to recap, what we do in UTI is that we classify all the listed companies in three buckets based on their return ROC. If the company is generating more than 18% ROC, that is classified as an R1 company. A company generating less than 10% ROC in last 5-year average is classified as R3. And the balance companies between 10 to 18% are classified as R2 company. So if you look at the 1-year returns on the left-hand table, what we'll notice is that in the last 4 years, R3 companies or companies with low ROC, or I would say the companies on the value end of the bucket or low quality bucket, have delivered very strong returns. While if you look at the R1 category of companies, although they have delivered decent absolute returns, they have delivered good absolute returns on a 4-year basis, except FY23, which was a weak year for the market. On a relative basis, obviously they have outperformed. And if you again look at the same thing on a 3-year and 5-year basis, you will notice the same pattern that on a 3-year basis, again, last 3 years, R3 has outperformed R1, while on a 5-year basis, last year, R3 has outperformed R1. Part of it is also due to the fact that it is a low base impact. If you look at on a 1-year basis, before FY21 for 3 years, R3 companies delivered very poor returns. Same way, if you look on a 3-year basis, before FY22 for 3 years, R3 companies delivered weak returns. So it's a combination of obviously a low base returns coming off from a low base, and obviously also in the how the economy has progressed and how the markets have looked at valuations and improving fundamentals. One other thing to highlight is if you look at the 3-year and 5-year returns, R1 companies are generally more consistent in their returns, while R2 and R3 companies are more cyclical. They tend to go through a period of poor returns, then followed by a very strong returns. In fact, if you notice, R1 companies on a 3-year and 5-year basis actually never deliver negative returns, while there are phases where R2 and R3 companies actually deliver negative return even on a 3-year and a 5-year CAGR basis. So basically, the point of this slide is that R1 companies are more stable returns, while R2 and R3 are slightly more cyclical. And in the current phase of market of last 3-4 years, we have seen R3 companies delivering better returns compared to R1 companies. And if you have to do the same analysis on a fundamental basis, basically we have looked at revenue growth, EBITDA growth, PAT growth, and OCF growth. And if you notice the last 3-year average, R3 companies actually have delivered very strong returns. Be it EBITDA growth, they have almost delivered 30% EBITDA CAGR, while the OCF CAGR also has been strong at 35%. And they have outperformed basically R1 companies. But when you go to 5-year and 10-year basis, you will see that R1 companies tend to have more steady returns, and they tend to deliver returns better than R3, as R3 companies in longer term had delivered weaker returns. Again, this points to the fact that the cycle of last 3 years have been very strong on the fundamental basis also in R3 companies, and that has led to very strong returns by R3 companies. And since they are cyclical in nature, Obviously, there will be a cycle when R3 companies again underperform both on fundamental and stock returns basis, and R1 companies could do better, which are more steady in nature. The point of the last two slides is that UTI focused fund as a strategy tends to follow a blend approach. So we have a core of the portfolio which invests in R1 companies, but we also try to invest in R2 and R3 companies to take advantage of those cyclical nature and cyclical opportunities as we can come and we can ride the cycle. And obviously we can shift between our portfolio between R1, R2, and R3 as we see valuations and the cyclicality of different sectors. So on this slide, you will see there are three buckets. Basically, what we try to do in this fund we follow a blend of growth and value. So to come to that blend, we try to identify opportunities in three buckets. And the core of the portfolio are the sustainable businesses, which are largely R1 companies, companies with strong return ratios, companies with good long runway for growth, and companies which we think have a pricing power or ability to gain market share or significant cost advantages, product innovation, network effects. So some bit of strong competitive advantage as well, and they have a good runway for growth. So that is, I would say, the core of the portfolio. On top of that, we try to generate alpha for the investors by betting on one bucket, which is cyclical opportunities. As the name suggests, these are companies which are cyclical in nature, where we think valuations are attractive, and there could be mean reversion both in valuations as well as fundamental performance. I mean, a simple example could be a commodity or a steel company going through a bad phase, and we believe the margins are at cyclically low and the margins can improve, and the valuations also can improve with that, and that we try to take advantage of that cyclical opportunity in that sector. So I would say some bit of portfolio will try to play in that bucket. And last is transformation opportunities, or I would say more of turnaround opportunities. And these are generally companies in which we have good history. Maybe because of some internal or external reasons, they are currently going through a challenging time. And if we feel there are some external or internal triggers could be like change in management, change in CEO, while external triggers could be change in competitive landscape, change in regulations, any other such reasons. And if we believe the company's performance can improve and starting valuations are still very cheap, and we can take advantage of the valuations as improving valuations as well as improving business fundamentals, we will try to identify such companies. So the combination of three put together, and as you makes the blend of growth and value. And as you can imagine, what I explained in the earlier slides, the cyclical companies which sit more in the R2 and the R3 bucket, and the steady businesses sit more in the R1 bucket. Based on that, we try to take advantage of the cyclical opportunities which we continue to find in R3 companies. So, but what is equally important in this fund, as we are taking very concentrated bets, the weight in each stock is much higher than in any other diversified fund, as we are supposed to invest in only 30 stocks. So what is important is what are the exclusion filters we apply for this fund. Starting from the right hand side, the inferior ROC and the inconsistent cash flow flows from the score alpha framework, which we have at the UTI at the research level, where if through a cycle, if we believe the company is unable to generate cash flows and ROC, obviously we'll try to avoid those kind of companies. The balance 3, if you look at management issues in terms of corporate governance, any issues with how they treat minority shareholders, companies where we feel the leverage is too high, or in businesses where we think the long-term sustainability can be questioned, I think we avoid all these companies because they could lead to a permanent loss of capital. So these are a few of the exclusion filters we try to apply when we look at investing in companies. Specifically, I would say for cyclical companies, leverage factor becomes very important, because if the cycle doesn't play out in our favor, and if the company has very high leverage, that could actually lead to bankruptcy risk, which is a permanent loss of capital for the investor. So these are some of the things we try to avoid while investing in all the companies.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.